Thank you, Jerry. That was quite an introduction, and thank you everybody for taking time out of your busy schedules to be here today, and thank you for all of you feeding in from New York. So my name is Richard Wang. Like Jerry said, I am a mortgage broker with The Loan Story. We're based in Santa Clara, California, and today I'm going to talk about training to be a homeowner. How many people, just a quick show of hands, are currently homeowners? And how many of you remaining want to be homeowners? Come on. Okay, good. So as Jerry mentioned, I am a triathlete, so I kind of made this analogy. Training to be a homeowner, it's not a simple transaction, okay? Buying a house is going to be probably the biggest purchase of your life, and it should warrant the attention that it deserves. You should make it the centerpiece of your entire wealth portfolio. And so I'm going to talk about and advocating you all to study, to strategize, and to build your own team and come up with a plan to buy a house, because it does really deserve that attention. And I've tailored this presentation particularly for you guys. So, you want to be a homeowner. This picture here has no home in it, and trust me, it has no home in it. Okay. So this is just kind of a representation of how I felt when I first bought my home. My first home, it's promising, it's kind of exciting, you don't know what you're going to get yourself into, but the road is also a little uncertain. It's a little daunting and sometimes treacherous, because you don't know what lies ahead. So my job today is to kind of lay the groundwork for you and give you a roadmap on how to best prepare yourself to become a homeowner, and give some insights and suggestions of how you can do that along the way. So why do you want to become a homeowner? Why is it such a popular thing? Any ideas on why you would become a homeowner? I asked my daughter, I gave this presentation to my daughter last night, and she said, well, you don't want to be homeless, right? Rents in Mountain View keep going up every year. That's true, and of course, what's that? It's one type of investment. That's exactly true. I'm going to go over really quickly some advantages of home ownership. Number one, it's the cheapest source of financing in the world, mortgage debt. Even though we're up probably anywhere from 0.5 to 0.75% from the all-time lows of 2012 and 13, it's still historically very, very low, 30-year fixed at around 4% for absolutely no costs. If you compare that to the time when I first did my first loan in 1993, when the interest rates hit 8%, we popped open the champagne corks because it was like the lowest ever. Nowadays, people are kind of spoiled, and anything above 4% is considered high. But if you look at the historical trend, 4% is actually very, very low. Home appreciation. What other investment can you think of where you can put 20% down, or 10, or even 0, as in the case with the VA loans, and enjoy 100% of the appreciation? The bank doesn't get any cut in your appreciation, right? So if you buy a home at $1 million and it increases, the value goes up to 1.2 in the following year, how much of that do you get? You enjoy all of it, it doesn't matter how much you put down. So it's an absolutely fantastic investment, as that gentleman said over there. Tax favorable treatment. So there's 3 ways that you can enjoy tax savings. Number one is the mortgage interest deduction. Across the United States, in any state, you can deduct the interest that you pay up to the first $1 million of acquisition debt. So if you have $1 million loan, you get to deduct the interest on that. In addition, there's also $100,000 of home equity debt that you can take subsequent to the purchase or with the purchase, and you can deduct that interest as well. That's the first tax favorable point. The second one is the gain. If you have an appreciation on your house, and by the way, the median housing price in California, if you take any 10-year period starting since 1950, there's never been a decrease. So as long as you're in the investment for a long-term objective, you really can't lose if you look at the historical trend. You can't say the same thing about the Dow, you can't say the same thing about the NASDAQ. Okay, but if you invest for at least 10 years, you'll almost certainly end up on top. And any gain, if you're a married couple, up to $500,000 is absolutely tax-free. Are you kidding me? $500,000 is tax-free. Above and beyond that, the third point of tax favorable treatment is that you're only taxed at a long-term capital gains rate maximum of which is now 20%. It used to be 15%. But still, that gain above and beyond $500,000 is taxed at a lower rate than the income tax rate. I think the highest bracket now is at 39.6 or something. So you get a break that way as well. You have tax favorable treatment. And then the last reason is prestige. Everybody wants to talk about the home that they just moved in, right? So low cost of borrowing, home appreciation, tax favorable treatment, and prestige, all compelling reasons on why you would want to become a homeowner. And so how do you become a homeowner? The purchase process. It's really easy, right? Heather Lang for the Intero Real Estate is here today to join us, and she's an expert in the area. Their purchase process is really easy, right? It just comes in 4 steps. Find your favorite realtor. Step 2.
That's not me.
That's not her. We have a much better looking one right here. Step 2, find a seller to enter into a contract. Step 3, find a lender. Fill out a loan application, get some money. And step 4, pick up your keys and move in. And that's it, right? Thank you for coming today. Wait a second. Let's go back here. Purchase process. Let's go back to step. Is that all? No, sadly, it's not all. This might be a little bit depressing, but hang on. I have some answers. Step 3, the loan process. Let's look at the fine print. Does anybody remember what happened in 2007? A little incident called the credit crisis. We used to receive rate sheets that were 7, 8 pages long every day from every lender. Overnight, literally, the next day, the 7 pages became 1. 30-year fixed and 15-year fixed. All the other programs just disappeared literally overnight. And banks like Bear Stearns, Lehman Brothers, Wachovia, Washington Mutual, Countrywide, IndyMac, the list goes on. This is a funny website called Implode Meter, and it lists 388 implosions since late 2006. So everybody knows about that. As a result of what happened, of all the lending of exotic programs, underwriting guidelines have tightened a lot since then. And they haven't let up. They've been everywhere from your appraisal to your income and asset evaluation. Everything is scrutinized like crazy. But what hasn't changed are the core components that make up the strength of every loan profile. So let's look at those. The core components are assets, income, and credit. Since the implosion, you really need to have all 3 legs to stand on. Before, in the Wild Wild West, you could have just 2 of these, or 1, or sometimes none, and still get a loan. So we're going to talk about these 3. You definitely need all of them in order to obtain what we call A-paper pricing. A-paper pricing is the best kind of interest rates you can get out there in the market. This is a quick aside. There are lenders called hard money lenders, which can lend on basically anything. If you have a pulse, they'll give you money. You just need to pay an extraordinarily high interest rate. That's not what this presentation is about. That's not the type of lending that we do. So I'm going to talk about this as it pertains to A-paper lending strictly. So your assets, how much do you have to put down as a down payment? So on the left side, we have different options. Oh wait, got my money icons. Okay, we have the left side of 0%, 3.5, or up to 19%. Any of those situations are for different kinds of loan products. But if you put down less than 20%, you're going to be paying some sort of fee. Whether if you're putting 0% down for a VA loan, you still have to pay a funding fee. If you put down 3.5% for an FHA loan, you still have to pay a mortgage insurance premium up front. If you put anything less than 20% for a conventional loan, you'll have to pay some form of mortgage insurance. And that's insurance that the bank will require in case you default because you're considered high risk if you put down less than 20%. On the right side, we have more traditional down payment amounts of 20, 25, and 40%. I picked those numbers because while no mortgage insurance is required if you put down 20%, you'll get additional price breaks if you put down more of a down payment. So at 25%, you'll get a better interest rate or less fees. If you put down 40%, you'll get a better interest rate or less fees. But there's no additional fees on top of the normal closing costs. Gift funds are okay. So if you have a rich aunt in Jersey, you can definitely use gift funds. Traditionally, you just need to have 5% of the down payment as your own funds. So if you have those uncles and aunts who you've always been nice to, they can give you money for a down payment. Generally, you want to keep your funds liquid and not tied up, because these days, underwriters will require that you have the money all ready to go to be sent to the escrow company for the down payment. So if they're tied up either in retirement or in stocks and bonds, make sure you liquidate them when you get to the point that you're serious about home buying and putting down an offer. And please, please, please don't make any transfers until you consult with your lender. It can become a real nightmare for not only your lender or broker, but also the underwriter in deciphering where the money moves and everything. So before you do anything, it's always a good idea to just talk with your lender. Income, not only do you need to have money, you need to make money. Unfortunately, to a lot of Googlers, I know. A lot of people may be cash rich, but even if you have enough money to buy the home, you won't be able to get a loan because you need to demonstrate a future source of income, a revenue stream, in order to get the loan. And the way we calculate that is what's called the debt-income ratio. And I'm just going to go over this in a basic fashion here. So your debts, what goes on the top, the numerator, it's either going to be housing or non-housing, and housing is going to be what you pay for the house, your principal and interest payment that is determined through the loan you get, property tax, which everybody has to pay, and home insurance. The second component of that is non-housing debt. So that's other mortgages if you already own real estate. It's installment debt, like your car loans or school loans. Don't ever get a car loan before you buy a house. That's the worst thing you can do. Revolving debt, like credit card balances, department store cards, gas cards, all those monthly payments are factored into the overall DTI. And on the denominator side, the bottom, we have income. So all of you are salaried, I assume, and you would count your gross income that's shown on your W-2. If you make bonus, and I hear you guys make bonus here, it is averaged over the last 2 years. So that can be counted as well. There's other factors that I'm not listing in here, but this is just a simplified version. And your goal for the DTI is to get at or less than 43%. As of January 10th, there's new rules that we have to follow. We actually have to make sure that our clients have the ability to repay. And one of the methods in satisfying the ability to repay rule is to make sure that you have a qualified mortgage. And a qualified mortgage is anything with a DTI at or less than 43%. Without getting into details, if you just want to gauge a quick rule of thumb on how much you can borrow, multiply your gross compensation times about 4 or 5. And that's where you can arrive at a basic range of what you can borrow. And add in your spouses too, if they work.
Borrow above the down payment.
Yes. That does not include the down payment. So that's your borrowing power, and then whatever you have as a down payment, you would add to that to come up with a kind of a sales price target.
Does that include like payments or just straight salary?
Yes, if you've been earning bonus for at least 2 years, you would add that to your total compensation.
How about with vested stock shares?
Vested stock shares, talk to me. There are a lot of other income streams that you may be overlooking. So make sure you talk to me before, if you want to get an accurate computation of your DTI. So you have assets, you need income, and then of course you also need credit. You need to demonstrate that you're creditworthy and that you can pay back your debts, right? Simply enough. Your credit score breaks down like this. Does anybody know what their credit score is? Susan? Okay. Okay. Your FICO score breaks down as follows. About 1/3, 35% is payment history. That's how have you demonstrated in the past your ability to repay debt? Have you ever been late? And if you've been late, how late? 30% is your amounts owed, what your balances are relative to the credit limits. You generally want to be careful of maxing out on credit cards, because that will really be detrimental to your score. 15% is your length of credit history. If you're new to the country, or if you just started applying for credit cards, you will need to establish a payment history over a certain amount of time, usually at least 12 to 24 months. We do have lenders that can lend on less than 12 months, but the interest rate and the terms will be less favorable. And then types of credit used is important too. If you just have a credit report full of credit cards, even though you've been making payments on time, and even if your balances are low or at zero, it's still not going to score as high as a credit profile that has revolving accounts, installment like a car loan, and of course mortgages. Mortgages that have excellent payment histories will do wonders for your credit score. Raising your score. If you're in a situation, if you're less than 720 FICO, you are above average, but there's still room for improvement. And here are just a few tips on how you can improve your credit score. It varies with each lender. So as a mortgage broker, we have access to about 50, we're approved with about 50 different lenders right now, and they all have different requirements based on what type of loan program you're applying for. But generally, anything over 740, you'll be okay. But I've seen some lenders offer bonuses at 780. But by the vast majority, if you have 740 and above, it's always going to be the same. Okay. 30% rule. For your credit cards, you generally want to keep your balances at most at 30% of the credit limit. So you don't want to, if you get that offer in the mail that gives you 0% interest if you transfer balances over, it's great on paper because you're paying 0% interest, but be careful on what that does to your credit score, because if you start shifting all that money around and you max out on that 0% card, that's going to actually take away from your score. It's counterintuitive because it's a smart thing to do on paper, but it's going to take away from your score because you're exceeding 30% of your credit limit. Okay. Quick tip, you want to make triple payments. If you are on the border, let's say you're at 718, 717, and you need a couple more points, you want to make your payment 3 times. And that doesn't mean you make the same payment 3 times. Let's say you have a balance of $100 that's due on the 1st of the month. So on the 10th, you make a payment of $30. On the 20th, you make a payment of $40. And then on the 30th, you make a payment of, what's left? $30 for the 100. And making that series of payments will tell the credit bureaus that you're actually more responsible. I don't know the logic behind it, but it works. And if you can do that, just to get a couple more points, you can do it. What you don't want to do is make the same payment 3 times. You don't want to pay $33 3 times in a row, because then they'll think you're on a payment plan. 3, don't open new accounts, especially before you apply for a mortgage. That includes, your savings at the department store, gas cards, and especially car loans, like I mentioned earlier. That's the worst thing you could do, because it's not only opening up new credit, which takes away from your risk profile, but it's also how recent it is. If you take it out right before you apply for a loan, it's really going to damage your score. And understand that it does take time. Improving your credit is like losing weight. It's not easy. It doesn't happen overnight. You need to work on it and be patient. If you haven't yet, you can always draw your credit report for free at annualcreditreport.com. They will give you your trade lines for free. You have to pay a small fee to get your actual scores, but if you ever wanted your lender or me to look at it, just your trade lines, we'd be happy to. And that leads me to talk about inquiries. So if you apply for a loan, either with the department store or with a credit card, they will pull your credit report and trigger an inquiry. And enough inquiries over time will take away from your FICO score. When you pull your own score, it does not count as an inquiry. So you can pull your own score as many times as you want and at a website like this, and it won't have any effect at all on your score. In fact, a lot of people monitor their score, which I recommend over time, just so you could continually see its growth. Assets, income, and credit. So those are the core components in step 3, which is the loan process. So is that it? Just get all your core components in order, and then you can go out and buy a house, right? Well, not around here, and probably not in New York either. Here's the challenge. We have housing data here, and I'm sorry if this is depressing, but prices continue to rise as sales are low. Look at that. Pending sales or closed sales. Any way you look at it, we are at an inventory level that's at about a 10-year low. I think it's come up since January, but it's still very, very low. There's not much out there. So Santa Clara County, the median home price, according to Zillow, is at $754,000, and that is a 14% year-to-year change. That means every month the values are going up by about $7,700 every single month. In New York, it's not much different. 9.3% one-year change year-to-year. Housing inventory in the Mid-Peninsula. If you look at Mountain View, there were 11 homes at the end of November. And in December, it did not get much better. It went down to 4, with a median sales price of 1.47. How do you compete? I've heard multiple offers of what? 70 offers on a home? Yuck. 3 housing projections for 2014. It doesn't look like it's going to get better. Home sales will surge, will skyrocket. Not necessarily skyrocket, but it will continue to increase 10 to 15% in 2014. Supply will struggle to keep up with demand. That's nothing new. Interest rates will increase significantly. I'm not sure about that, but I do believe that rates will be closer to 6 than 5. Maybe not, maybe 5. Okay, so it's all kind of bleak, right? Maybe not. Kind of feel like that guy right now? Okay, so my job is to give you that roadmap today on what you can do to maximize your chances to get into the house of your dreams. And it's pretty simple. Number 1, get your core components in order. Assets, income, credit. If you feel that you have a weak spot in any of those areas, that's what you want to take care of first. If your credit isn't up to par, draw your own credit report and start working on it. If you don't have enough assets, start saving. If you don't have enough income, marry somebody, and then you can double your income. And so, I'm kidding. We do have programs where we can have co-signers apply at the same time through Freddie Mac's product. And so there are creative ways to increase your income quickly. Now here's a very important tip. Consider a TBD approval. So there are different levels of review of your loan application prior to going out and house hunting. There's pre-qualification, which traditionally just means, hey, I talked to you over the phone, you tell me what your income and how much money you have for a down payment. I punch some numbers on a calculator, and this is what you can afford. You're pre-qualified for. A higher level of review is called a pre-approval. That's where I see all your income asset documentation. I might draw your credit. I'll take a closer look at everything and issue a pre-approval letter with my signature on it. And that's what traditionally realtors and listing agents will ask for, sellers will ask for when you make an offer. An even higher level of review, which is a little bit more recent and what I feel is going to be mainstream by the end of the year, is called a TBD approval. TBD stands for to be determined. And that means that we collect all your information and actually submit it to the lender. A live underwriter reviews everything and issues a credit approval based on certain conditions. You can even work to satisfy those conditions before a property is even identified, before you're even in contract. And with that approval in hand, it gives you so much leverage when you're going into a competitive bidding situation. And I'll talk about that more. 3 is build the right team. I see a lot of buyers, kind of take a backseat approach to home buying. It's kind of strange because it is the most expensive, the biggest purchase of your life, right? And it should be the centerpiece of your wealth building strategy. But I don't see a lot of people building the right team around them. That means the right lender, the right realtor, the right financial planner. Make sure everybody is in sync and that there's communication on what the best plan for you should be. Unfortunately, there are a lot of bad apples in the lending industry. There are a lot of bad apples in the real estate industry. And it's vitally important to follow recommendations of people you trust and build your right team. And I'll talk about that more too. Real quickly, when you're going up against people with all cash offers, which surprisingly happens a lot around here, but I heard some statistic like 20 to 25% of the homes around here are purchased with all cash offers. How do you compete with that? First of all, if you have the cash to buy a house, don't do it. It's absolutely the worst thing you could do for your financial portfolio. for a variety of reasons. If you have bought your house already with all cash, we can help you with a loan program that's called delayed financing. That means you can get your equity back immediately after you purchase and still qualify for the mortgage interest deduction. But that said, you generally do not want to plump all your cash down and liquidate. It's one of the worst things you can do. It's like paying down your mortgage. You want to die with the biggest mortgage possible. That's a different presentation. So I'm going to talk a little bit more detail about to be determined approvals because I saw a lot of interest and eyebrows raised for that. The pros. So again, these are full credit files that are underwritten by a live person and it's approved. It removes uncertainty. When a listing agent sees a to be determined approval, they know that it's almost as good as all cash. The only thing that needs to be conditioned for and looked at that point is the property appraisal. It just needs to appraise up to the sales price. They just need to make sure the walls are up and that there's no water leaks. Number two, it results in faster closes. So even if you don't have any uncertainty in your loan profile, you're very well qualified, you have a bunch of money, you make a ton of income, and you have pristine credit, to be determined approvals are still very compelling because you don't have to go through that whole underwriting process. It cuts down your time in half. And so if the seller is a motivated seller and needs you to close in 2 weeks, 14 days, 10 days, we can do it. Because with this TBD approval in hand, there's very, very little steps to go from that point on. You just need to do the appraisal, which we can do in 3 days, and then close escrow in as early as 10 days. The cons, which are a little bit minor. Number one, a credit inquiry is triggered. So I would only recommend a TBD approval if you are serious about buying a home and if you're ready. Number two, your selection of lenders is limited. So it's not the case with banks, but I'm a broker, so I have a wide variety of lenders to choose from. So not all offer the TBD right now. I think it's going to be a thing in the future that all lenders will eventually come on board with this. But for now, there are only a select few lenders that offer TBD. And what that means is, as our pool of lenders is narrowed, we sometimes don't have the best pricing or the best interest rates for that. So that is a con. You may not have the best pricing with a TBD. But you could always refinance 6 months later too, assuming interest rates stay the same. The result is, with the TBD in hand, you are seriously on a level playing field with all cash offers. And once your offer is accepted, then what? Well, for TBD, like I said, all you have to do is the appraisal. Otherwise, if you don't have a TBD in hand, you do have to go through the process, choosing a loan program and going through closing costs and the rate lock discussion. I had DPA programs in there. It's kind of out of place because it doesn't really apply here. It's down payment assistance programs. So we do offer down payment assistance programs too at the city, county, and state levels if you need that. But I didn't include it in my Google presentation. The Loan Story, that's the name of my company. We are mortgage brokers, and that is me. I've been licensed since 1992, closed over 1,000 loan transactions, 450 million almost. I am an attorney. I don't like to disclose it always, but I am a member of the State Bar, and I can offer legal advice, such as how you title your assets, a little bonus. And I am a current member of the California Association of Mortgage Professionals. And now I would like to open it up to questions. Good question. It also depends on the lender, but generally it's 90 to 120 days. So that gives you a good chunk of time. I know from what Heather tells me, there's a lot of trial and error out there. And so you're almost certainly not going to win a bid your first time out. So that gives you a good chunk of time, 3 to 4 months, as you have the TBD approval to go out and make offers. It's free. We don't charge any application fee. We don't charge any credit report fee. Yes, at that point, it's just like a new loan. We would have to resubmit, right? That's actually never happened to me before. Every TBD approval that we issue, they've been able to use it to get into a house. So it's very, very critical that you do that. Yes, so it depends how badly you want the house, frankly. We can do loans for people with no credit history. We can do loans with people with no Social Security, actually. We have foreign national programs. But if you have a short credit history, we can get you into A-paper lending. It's just that your selection of lenders will be narrowed, so the interest rate might not be as favorable. It depends on your goals. Like I said, if you're in it for a long-term investment, the market timing is less important, right? But then you have to see how long it's going to take me to get up to this 20% level, or how long is it going to take me to establish a FICO score. It doesn't usually take that long. I think Heather might be a good resource for this too, but in general, condos are going to increase and decrease at a lesser extent than single-family homes. I just want to add to that, when you make the decision of whether to buy a condo or a single-family home, just make sure that you consult with the right people, because there are drawbacks to buying a condo. Jerry knows better than anybody, because when you have to pay money to an HOA that controls the transferability of your house, and Satish knows this too, it can be frustrating, especially in a time when everybody's refinancing to low interest rates. You may not be able to if the HOA is in trouble or involved in litigation in some fashion.
Yeah, that changes. Yeah, so those are all very good questions to ask your realtor.
I have a quick question. Can you guys hear me?
Yeah, I can see you too.
Yeah, cool. So you said that paying in cash is a very bad thing. Why is that?
Well, making an all-cash offer to me is just an extreme state of paying down your mortgage. And I mentioned that you want to die with the biggest mortgage ever. And the reason I say that is, mortgage debt is the cheapest source of financing in the world. You want to maximize it. It should be considered good debt, because if you have a choice, if you have money to put down into your house or into another investment vehicle, you should always choose the other one, because your rate of return almost anywhere else, especially over a long-term period, is going to beat the after-tax effect of paying down your mortgage. That's step one, rate of return. Okay. The second reason, which is as if not more important, is liquidity. Once you put money into your house, you cannot get it back unless you sell or refinance. So I can't tell you how many times past clients have called me and asked me, I need money for home improvement, for another house, another investment property, or my kids going to college, I need money. How do I get it? And they realize they can't get it at the same interest rate that they got their first loan now, especially since that rates are up. And that it's difficult. They have to avail themselves to the market at that time, which is risky. And then they have to go through the loan process, which can be a nightmare. So liquidity is huge. The rate of return and liquidity. I follow a gentleman by the name of Rick Edelman. He's a financial guru, and he wrote this book called Truth About Money. And it talks all about how we're in the mindset always of paying down your mortgage, because that's what our parents did, and that's what prior generations did. But if you look at it on paper, it is a no-brainer. If you put your money elsewhere, you will make that loan amount quicker than if you pay down your mortgage over time. Does that answer your question?
Paying up to 40% of down payment, but not more?
I would never put more than 40%. There's absolutely no reason to. In fact, the lower loan amount you have, the higher interest rate you're going to get, with all things being equal. Yes. So let me expand. So there are 3 different loan amount levels. You have your traditional conforming, which is 0 to 417,000 in the Bay Area counties. And then there's a middle tier from 417,001 to 625,500. That's called a high balance conforming in the Bay Area counties. And that's a different pricing structure. And then beyond 625,500 are your traditional jumbo loans. In any of those tiers, the more that you borrow, the better the interest rate until you exceed the threshold into the next tier. Down payment assistance programs?
Yes.
Yeah, so there's a variety of down payment assistance programs that are offered at almost every level of government. And the catch-22 is that you can't make a lot of money to qualify for these programs that you need to buy these expensive homes, especially in this area. So they're kind of far and few between, to be honest with you, in the Bay Area, because I think for most of them, if you make an excess of 125, something like that, you don't even qualify. And they come in different forms. Like there are some that you can use for their down payment that you have to repay later, and then there's some that you have to repay over time. I'm not as clear on those, but they're available, but generally they're hard to come by. I didn't think I would get that question here.
Often they're offered to teachers as well.
Yeah. FHA offers a lot of good neighbor loans as well. So for teachers, firefighters, policemen, they're very popular with those. And then, of course, you have your VA loans for veterans too.
And I will tell you again, depending on the area and the competition, that you may be eligible for those programs, but sellers may not be interested in.
That's the other issue. If a seller looks at an offer that has a down payment assistance program attached to it, is that how much leverage is that going to be?
Sometimes they take a little longer to close, so it just reduces your ability to compete.
Borrow from your aunt. That's a better strategy.
Do you recommend borrowing from the 401k? Because we're going to go away for $50,000.
It depends on the terms. It's possible, but it depends on the terms of the program.
And I just attended the first time homebuyer presentation by Richard Wang. And one thing that I thought was really useful was when he talked about the DTI, the debt to income ratio, and about things you can do to improve your credit score. And I think those things are useful for preparing to buy your home.
Richard has been our loan broker for about 5 years. He's helped us with 2 refis and helped us get a new home loan. Richard is very knowledgeable, and his knowledge made the whole process very simple and streamlined. His relationships with the banks and the lenders were invaluable and helped us close on time each time.
I'm actually a neighbor of Richard Wang. We've been his client for the last several years now. He's helped us refinance our loan, to get us into a really good rate. The mortgage that we have right now, we're really happy with because it fits our needs. And this was something that Richard really helped us with because he understood what our needs were as a client and helped us, steer us into the right product to fit our need. Rick is a true professional in the industry. I've known him for many years now, and he has a very extensive client base, and his clients really, show that they appreciate him by giving him referrals. And so I know he has a large client base with very happy customers, and we're one of them.
Hi, my name is Sarah Nguyen, and I just attended the first time home buyer presentation by Richard Wang. One thing I learned about was the TBD approval versus a pre-approval, which hopefully lets you compete better with all cash offers.